On December 28, 2025, something happened that has never happened in the history of modern financial markets. Gold, silver, and Bitcoin all broke records on the same day. And if you think this is a bull market, you have completely misunderstood what you're watching. This is not money flowing into assets. This is money fleeing from something else. This is a system alert, and what happens over the next 60 to 90 days will determine whether the financial architecture that has governed global markets since 1971 survives or collapses into something your grandchildren will study, the way you studied the Great Depression. The financial media will call this inflation hedging. They will explain portfolio diversification and safe haven demand, and every word of that analysis is designed to keep you calm, to keep you thinking this is normal market behavior. But here is what they are not telling you. When gold, silver, and Bitcoin all break records simultaneously, that has never happened. Not in 2008, not in 2020, not during any previous crisis, because these assets do not naturally move together unless something deeper than market sentiment is driving them, unless the common denominator is not optimism about these assets, but loss of confidence in everything else. Think about what it means for these three completely different assets to reach historic levels at once. Gold is the oldest monetary metal held by central banks. Silver is an industrial commodity consumed by solar panels and electronics. Bitcoin is a digital protocol with no physical form and no government backing. These assets have nothing in common except one thing: they exist outside the banking system. They cannot be created by central banks. They cannot be printed or diluted at will. And when all three surge simultaneously, what you are watching is not people buying these assets. What you are watching is people leaving the system that creates dollars and euros and yen. The confirmation that this is different comes from velocity. These are not gradual appreciations driven by improving fundamentals or slowly building demand. These are panic moves, and the panic is not in the assets going up. The panic is in the realization of what happens if you stay in the assets going down, meaning cash, meaning bonds, meaning anything denominated in currencies that central banks control. And the timeline becomes critical here because we are not at the climax of this crisis. We are at the recognition phase, the moment when enough institutional players have seen enough data to understand that something irreversible is happening. Let me show you what I mean by laying out the hidden stress indicators that appeared in the 72 hours before these breakouts. And pay attention to the sequence because the sequence reveals who knew what and when they acted. On December 26, the Federal Reserve announced $40 billion per month in Treasury purchases. They called it routine reserve management to maintain adequate liquidity. But routine reserve management does not happen at $40 billion per month. This is emergency liquidity injection disguised as ordinary operations, and the timing tells you everything about who needed the money and why. The next signal came 24 hours later, on December 27th. Something extraordinary appeared in the Federal Reserve's discount window. $17 billion in emergency borrowing hit in a single day. And this matters because discount window borrowing carries stigma. Banks avoid it because it signals distress. So when $17 billion shows up in one day, what you are seeing is multiple institutions that have run out of options, that have exhausted every other source of funding, that are facing margin calls or settlement obligations they cannot meet without direct central bank intervention. This is not routine stress. This is institutional panic. Then on December 28th, the same day gold, silver, and Bitcoin broke records. The World Gold Council reported something that should have been headline news but was buried in technical market updates. Central banks purchased an estimated $17 billion worth of gold in the previous 72 hours, not over a quarter, not over a month, in 3 days. And understand what this means. These are not speculative buyers. These are monetary authorities from China, Russia, Poland, India, Turkey. Institutions that manage national reserves and make decisions based on decades-long strategic planning. And when central banks buy gold at record prices without waiting for pullbacks, they are not investing, they are escaping. Now combine those three data points and the pattern becomes undeniable. $40 billion in Fed Treasury purchases, $17 billion in emergency bank borrowing, $17 billion in central bank gold buying, all within 72 hours, all while these assets hit records. This is not a bull market. This is a liquidity crisis and everything else. Institutions are scrambling for cash, central banks are scrambling for hard assets, and the Fed is printing money at emergency levels while pretending this is routine. The system is not functioning, and the price movements are the symptom, not the cause. But the real crisis, the one that makes this different from every previous episode of financial stress, is not the liquidity shortage. Liquidity problems can be solved by central banks printing money. The real crisis is confidence breakdown. And confidence breakdown operates on a completely different timeline, because confidence problems cannot be solved by printing more of the thing people no longer trust. What we are watching right now is the early phase of confidence collapse, the phase where institutional players and sovereign nations quietly reposition before the general public understands what is happening. The phase where billions move without making headlines. The phase where the financial media runs stories about holiday shopping while the foundation cracks. Here is how you know this is confidence crisis and not liquidity crisis. The Federal Reserve has unlimited capacity to create dollars. They proved this when they created trillions in 2020. They can inject as much liquidity as any bank needs. Boom to air. So liquidity alone cannot explain why banks are borrowing at penalty rates unless the problem is not finding dollars but finding counterparties willing to lend dollars. Unless the problem is that other banks have seen the same stress indicators and are hoarding liquidity because they do not trust that borrowers can repay. That is confidence breakdown. And confidence problems spiral because the act of hoarding liquidity makes other institutions hoard liquidity, which makes the shortage worse, which makes the panic spread. The gold buying reveals the same pattern but more explicitly. Central banks purchasing 17 billion in 72 hours at record prices means they are not worried about overpaying. They are worried about availability. They are worried that if they wait, the metal will not be there at any price. And that fear only makes sense if they believe the current system of paper gold trading is about to fail, is about to experience delivery demands that exceed physical supply, is about to prove that price discovery has been based on contracts that never had metal backing them. And when central banks act on that belief by buying physical at records, they are not speculating, they are front-running collapse. Silver tells the same story but with mathematics that are even more extreme. And this is where the structural impossibility becomes visible. COMEX registered inventory stands at 68 million ounces. This is the physical metal available for delivery against futures contracts. But total open interest stands at 512,000 contracts. And here is the number that matters. Each contract represents 5,000 ounces. Do that calculation and you get 2.56 billion ounces of paper claims, which creates a ratio that cannot survive scrutiny. There are 38 paper claims for every ounce of physical metal in the vault. That ratio only works if almost nobody ever demands delivery, if almost everyone settles in cash, if the system continues operating on the assumption that paper and physical are equivalent. But when silver breaks records on the same day gold and Bitcoin break records, that assumption is breaking. Industrial buyers who need metal for solar panels are demanding physical delivery instead of accepting cash. Investment funds are standing for delivery instead of rolling contracts forward. Sovereign nations are requesting transfer to their own custody, and every delivery demand drains the registered inventory, and every drain accelerates velocity because it makes the ratio worse. Think about what happens when the ratio reaches 50 to 1 or 60 to 1. Someone does the math and realizes this is a bank run, that the vault has been drained, that COMEX cannot honor delivery demands, that the paper price is fiction, and when that realization spreads, when enough buyers simultaneously demand delivery, the exchange faces two options, and both are catastrophic. They can force cash settlement and admit the system is fraudulent, which proves paper contracts are worthless and drives all buying to physical markets. Or they can let prices spike to whatever level attracts enough sellers to satisfy demands, which destroys banks holding short positions and forces regulatory intervention. Either option ends the current structure, so COMEX is trapped between admitting fraud and allowing chaos. Bitcoin at 100,000 adds a dimension that makes this more dangerous because Bitcoin is not physical commodity. It cannot be drained from vaults or experience delivery failure. Bitcoin exists on distributed ledger. You either control the keys or you do not. There is no paper Bitcoin in the way there are paper metals. So when Bitcoin breaks 100,000 on the same day gold and silver break records, what you are watching is not the same phenomenon. You are watching something more fundamental. You are watching the realization that digital scarcity is more trustworthy than government promises. That code-enforced supply limits are more reliable than central bank inflation targets. The institutions buying Bitcoin at 100,000 are not doing so because they believe the technology is revolutionary. They are doing so because they have lost faith in the alternatives, and that loss of faith shows up in the coordination. When Bitcoin crosses major thresholds while precious metals simultaneously break records, portfolio diversification cannot explain the timing. Something else is driving all three assets at once, and that something is the realization that staying in the traditional system carries more risk than buying record-high alternative assets. This is not speculation. This is fear disguised as allocation. Now we get to the part that makes this irreversible, the part where structure makes confidence collapse self-reinforcing regardless of policy response. Commercial banks and investment banks hold derivative positions in precious metals totaling hundreds of billions in notional exposure. Most of these positions were established when prices were far lower. They are short positions, bets that prices would stay contained, and at current levels these institutions are sitting on over $120 billion in mark-to-market losses, and understand that this is not spread across hundreds of firms. This is concentrated exposure across the 5 largest U.S. banks that dominate precious metals trading. When you concentrate $120 billion in losses among 5 institutions, you create counterparty risk that spreads through every market those banks touch. because these institutions are not just metals traders, they are counterparties in interest rate swaps, currency derivatives, equity options. They sit at the center of the global derivatives market, and if precious metals losses force one of them to raise capital by liquidating positions elsewhere, that selling creates pressure in those markets, which creates losses for other institutions, which creates more liquidation. This is how systemic events unfold. Losses in one corner metastasize as institutions scramble to preserve capital and counterparties refuse to trade with firms showing stress. The Federal Reserve understands this dynamic. The $40 billion per month in Treasury purchases and the $17 billion in emergency lending are designed to prevent cascade. They are flooding the system, hoping banks can meet margin calls without forced liquidation, hoping they can absorb $120 billion in metals losses without triggering broader instability. But there is a fundamental problem with this strategy that makes it worse rather than better. The more liquidity the Fed creates, the more currency debasement accelerates, the more investors lose confidence in the dollar, the more they buy gold, silver, and Bitcoin, which drives prices higher, which increases bank losses, which requires more Fed liquidity. The feedback loop is self-reinforcing. Once it begins, once confidence starts breaking, printing more money accelerates the problem because the printing is what people are running from. This is the trap that central banks face in late-stage fiat systems. The tools they have to solve liquidity problems make confidence problems worse, and we are now at the stage where the crisis is confidence, not liquidity, which means the Fed's response, no matter how aggressive, cannot stop what is coming. It can only determine how violently the transition happens. This is why the timeline matters so critically. We are in the window between recognition and reaction. Institutional players and sovereign nations have recognized that something irreversible is unfolding. That is why $17 billion in gold purchases happened in 72 hours. That is why central banks are buying at record prices. But public reaction has not arrived yet. Retail investors still think this is normal rally. Financial media still frames this as inflation hedging. The general population still trusts that their dollars and bonds are safe, and that gap between institutional recognition and public awareness is the window where positioning happens. That window is closing over weeks, not years. December 31st brings year-end reporting where bank losses become public. January brings employment data and Fed meetings where policy response becomes visible. February brings solar procurement and Chinese New Year buying that drains remaining inventory. March brings recognition phase where enough people understand the system is not functioning normally, and somewhere in that timeline the gap closes. Public awareness catches up to institutional positioning, and when that happens, the repricing is not gradual, it is violent and discontinuous, because everyone who is waiting tries to move at once. Gold at 4,530, and silver at 78, and Bitcoin at 100,000. These are not the destination, these are the starting prices of the next phase. The phase where paper markets openly fail to deliver physical metals, where exchanges implement rule changes, proving the system was fraudulent, where central banks accelerate buying until the buying itself becomes the news, where institutions holding $120 billion in losses either get bailed out, proving moral hazard is permanent, or fail, proving the system is fragile. Either outcome destroys confidence further. The historical parallels are limited because we have never been here before. We have never had these three assets break records simultaneously. We have never had central banks buying at this velocity while commercial banks hemorrhage these losses while the Fed injects this liquidity. The 1970s, 2008, 2020. None of these episodes combined all the elements we see now, and the reason historical parallels are limited is because this is not cyclical, this is structural. This is the consequence of 54 years of fiat currency experiments since Nixon closed the gold window. This is what happens when mathematical limits of debt-based systems reach the point where no intervention can maintain confidence. People ask what to do, what positions to take, and those questions miss the point entirely, because this is not investment opportunity. This is system transition, a restructuring of how value is stored and exchanged. And in system transitions, the question is not how to profit, but how to preserve. Not which assets go up most, but which assets survive the transition. And the answer has been the same for 5,000 years. The assets that exist outside the system, the assets that cannot be created by decree or diluted by policy, the assets that are now breaking records simultaneously because enough people understand that the system has passed the point where it can be fixed. This is not the climax. This is not even the middle. This is the opening phase, the part where institutional players reposition, where central banks front-run collapse, where banks take emergency loans and the Fed prints emergency liquidity, the part where prices hit records but most people still think this is normal behavior. The climax comes when the gap closes, when public awareness catches up to institutional positioning, when everyone simultaneously realizes that the paper claims they thought represented value are nothing but entries in databases maintained by institutions that cannot honor delivery, And when that realization spreads, the transition is not measured in months, it is measured in weeks or days. December 28, 2025, gold, silver, Bitcoin, all breaking records on the same day. This is not an investment opportunity. This is not a bull market. This is a system alert. And the alert is telling you that something has broken in the architecture of global finance, something that cannot be repaired by central bank intervention or regulatory changes, something that is now moving toward its inevitable conclusion. And your position right now is not whether to believe this analysis. Your position is whether you are prepared for what happens when confidence collapse accelerates from the institutional level where it is now to the public level where it is headed. Because that transition is not gradual. That transition is the moment when the system everyone trusted reveals it never had the backing it claimed, and by the time that revelation is obvious to everyone, the moment to reposition has already passed.